All right. Well, good morning and welcome to our Q4 edition of the OneAscent Market Update. We've been holding these webinars and calls for almost 4 years now, and we got a lot of great information to share today. It's been a choppy, rough start to the year, first 3 quarters of the year. So a lot of information to share today, but thank you for being with us. As we do, I'll open us in a quick word of prayer, and then we'll get started. Heavenly Father God, thank you for today. Thank you for just the breath in our lungs and the fact that we get to do the things that we get to do. Each interaction that we have, each person that we get to run across. Lord, I thank you for that. I thank you for the chance to speak now about the markets and finance and this thing called money that you've given us. Lord, I pray that you allow it to not to rule in our hearts, but allow it to be a tool. And so Lord, I pray for us as we speak, give us clarity, give us wisdom, that we might communicate effectively. And we ask this in your son's name. Amen. Well, again, thank you for joining us this morning. As we get started, I want to introduce today's speakers. I'll be joined today. My name is Cole Pearson. I'm the president of our investment solutions group here at OneAscent, and I have the pleasure of leading our team who brings values-based solutions into the marketplace. I'll be joined this morning by Andy Manton, who's our chief equity strategist and senior portfolio manager. He'll get to do our manager spotlight, talking about the international equity markets. And we'll finish our time this morning with Nathan Willis. Nathan is our director of portfolio strategy. He leads our multi-asset team where we think about and allocate across multiple markets, and he'll provide an update from our asset allocation committee and kind of our outlook as we move into the last part of the year. Just a quick agenda here and some housekeeping items. As I said, we'll have our 3 speakers. If you have questions throughout the call, please submit those to info@oneascent.com. You can send those to us by email, and we'll try to get those answered on the call if we can. If not, we'll follow up afterwards. You also can use the Q&A box there in Zoom, and you can submit your questions that way as well. This is a call that we have every quarter to provide an update on what's happened and our outlook for the markets. So go ahead and mark your calendars. As we move into next year, 2023, January 17th will be the next market update call. And we hope that you can join us then. Well, as we get started, I wanted to kind of just address what's gone on in the markets so far this year and also in the third quarter. You can see here several different asset classes. All this performance is through September 30th, the end of Q3. And just want to highlight a few points as we get started this morning. First is that global stocks and bonds were down roughly 20% or more year to date. If you look here in this, if I can get my laser pointer, this year to date column, it's been a rough year, both for stocks and bonds, which is unfortunate. When you look inside of that, just in Q3, we've actually had a little bit of a reversal. Mid cap and small cap stocks have actually outperformed large cap here in the US in the third quarter. When we look at international stocks for the year, they've moderately or slightly underperformed the U.S. markets, but that was especially true in the third quarter. International stocks fared worse than U.S. stocks. And then when we look at bonds, it's been one of the worst bond markets on record. Corporate bonds, just as an example, were down 15% in the 1930s, and globally, bonds are down 15 to 20%. So far this year. All this has led to really the worst start for what's called a balanced portfolio, a 60% stock, 40% bond portfolio, the worst start for a year since 1974. And unfortunately, we've not been immune to that. I want to also address the OneAscent performance. Here on this slide, you're seeing our peak allocation series, which is just one of the many types of strategies that we manage on behalf of advisors and their clients. And here you can see each allocation relative to its risk-based benchmark and then the plus or minus. So if we look at the year-to-date period, which is what we were just reviewing for the broad markets, you can see we've fared similarly. In some cases, we've moderately or slightly underperformed the broad market in the year-to-date and 1 year time period. What's been encouraging to see is in the past month and also all of Q3, that trend has begun to change. So here in this 1 month and 3 month column, you can see the dark green there where we've actually outperformed on a relative basis. And you can see that also is on par with our long-term performance as well. For all of the 3-year periods, we're outperforming our benchmarks net of fees. And many of you know that OneAscent celebrated its 5-year anniversary in February of this year. That means that we now have a 5-year track record, or 5 years worth of performance history that we can show and document. And for 3 out of the 4 strategies that have a 5-year track record, we actually are continuing to outperform on an annualized basis net of fees. What we believe this indicates and alludes to is a sound strategy and a sound process. We believe in our process, we believe in our managers, and we believe that will continue over the long term. As I kind of begin to wrap up my portion this morning, we move to our speakers. When I think about strategy and process, it really starts with philosophy. What do we believe? And in times like this year in 2022, we can tend to forget. We can get short-term focused, and we can get emotional. And so it's important to harken back to what we call our investment philosophy. Our investment philosophy really is, at OneAscent, is based on 3 things. First is values-based. We believe that aligning your investments with your values is a wise approach to investing. At the end of the day, investing is ownership. And so we want to know what we own, and we want to be aligned with those companies and what we're hoping to see furthered in the world. Number 2, as we think about our financial assets and resources that God's given us to steward, is long-term. We maintain a long-term focus in our investment analysis, how we're thinking about kind of the long arc of history and the corporate life cycles, which we'll talk about in a minute, but also how we run our business. We can get distracted sometimes when the waves get choppy, and we can get focused on what's right in front of us. But for us, as we think about the long arc of history, and for you, as you think about your long-term goals, whatever those are for you, as you work with your advisor, or if you're an advisor, as you work with your clients, keeping that long-term focus. And lastly is global diversification. There are a lot of opportunities and a lot of companies and a lot of markets that we can invest in. So what we do at OneAscent is we invest across multiple markets and asset classes so that we can do 2 things. We want to mitigate risk, and we want to enhance our opportunity set, our potential for long-term return. So that's our investment philosophy. I want to unpack that first piece a little deeper with another belief statement. And it's this. You can see it here on the screen. We believe that business is a powerful engine that impacts the world. Therefore, we invest intentionally. When you think about impact, it's really just a force, right? One thing impacting another. So as investors, we want to do 2 things. We want to know who we're impacting and how we're impacting them. And that's what we call values-based investing. And so I want to just remind you real quickly of our approach to values-based investing and how we do that. So when we think about business and who a business may be impacting, we believe business impacts people and it impacts places. The employees and the customers and the suppliers who interact with that business on a day-to-day basis, but also the environment, the community, and the society where that business operates. That's what business touches, those groups every single day. For us at OneAscent, we believe that God created every single person and every square inch. And as stewards, we need to be thoughtful about how we engage and through our investing in the businesses and how they engage those groups. So from a practical standpoint, what that looks like is, number 1, we want to eliminate companies whose products or practices are causing harm. If that impact is negative, if they're harming these groups, we simply want to eliminate them from our investable universe. And we want to focus on those that are at least neutral, but hopefully adding some value. That's the first step, eliminate. Number 2, though, is evaluate. At the end of the day, we are investing. And so we want to evaluate companies to make sure that we're finding those that are meeting our investment objectives. We manage a number of different strategies at OneAscent. They all have different outcomes and different risk profiles, depending on what makes sense for you. We're evaluating them to make sure they meet that objective. So we want to make sure that they're great investments. But lastly is what we call elevate. So 3 E's here: eliminate, evaluate, and finally elevate. We want to elevate the companies who are making the world a better place. When we think about investing, again, it's ownership. We're owning a part of a company, and we hope that whatever that company does, if and when it's successful, that impact that it's having on the people and places is something that we're proud to see furthered, that's making the world a better place. When we ultimately are directing capital to those businesses, we want it to be of that positive impact. So that's just a little bit of our process and how we do that. I'm excited to introduce to you today Andy Manton, who's going to serve in our manager spotlight. Andy is actually not new to these calls. He's joined us, I believe, twice before. Andy is a unique example where if you followed these calls for the last number of years, we really have to do two things well at OneAscent Investments. We need to allocate well. We need to understand what's happening in the markets and how those things interact and affect each other. And Nathan's going to speak to that here in just a little bit. But the second thing we have to do is find great managers. We've always had an approach to find world-class managers in every category who can integrate their strategy in a values-based way. And Andy is an example of a manager that we found about 3 years ago. Andy was working at another firm, running an international strategy that was world-class. And through just relationship and connecting and through our diligence, we began to use his strategies inside of our solutions here at OneAscent. Well, fast forward to this time last year, roughly, and Andy felt called to join our team. We were using him when he was at another firm, and he now is on our team at OneAscent, and we're so excited to have him. Since then, Andy has taken over some of our strategies that we manage in our ETFs, and just recently, a few weeks ago, about a month ago, we launched an international equity ETF and an emerging market ETF that Andy runs. And so, Andy, I'm excited to have you join us today and to share about international equity investing. Thanks for being with us.
Thank you, Cole. That was a great introduction. And from what Cole just said, if you didn't know me before, I think you probably have a good idea of who I am now. But for those of you that don't really know me, again, my name is Andy Manton. I joined OneAscent at the end of the year last year, as Cole mentioned. And I was previously with another firm called Shelton Capital, where I managed an international and emerging markets equity fund there. And prior to that, I worked with some other firms, some big firms like Merrill Lynch and Deutsche Bank, and some small firms like Victory Capital and WHV Investments. My focus has always really been on global equity markets as an analyst or portfolio manager. And as Cole mentioned, here at OneAscent, I now manage the large cap core ETF and the newly launched international and EM equity funds. And being that we're starting these two funds, we just started them recently. I'm here today really to talk to you about the international investing, international markets, and my investment process. But quickly though, before I jump into that, I just wanted to talk a little bit about why I came to OneAscent. I've been getting some questions about that. And really, it goes back many years now. As Cole mentioned, he was really the first one to introduce me to the values-based investing community a little over 3 years ago. And as I moved closer to the community and started talking to a lot of advisors, I realized that there really was a lot of work that needed to be done, really on the education side. As I talked to advisors, it became clear really to me that there was a clear gap in the direction that a lot of advisors wanted to take their business, and just not really knowing how they're going to do that. So I guess in other words, it seemed like many advisors didn't quite know how to talk to their clients about values-based investing, or maybe felt too separated from the portfolio managers to really understand what they were doing. But to me, that really kind of broke my heart. But I realized, I just wanted to I wanted to help really in a bigger way. I wanted to be more on the front lines with you and your clients. And I've been with secular firms my whole career, which was okay for me. And I knew I was there for a reason, but there was a time last year where I clearly heard it's time. So I put myself out there, and Cole approached me about what they wanted to do here at OneAscent, and it seemed like just a perfect fit. And really, for me, it's really who OneAscent is. It's a wealth management firm primarily, and I see it as more of multifamily office with now an in-house asset management capability. So I'm really excited to be here, and just wanted to share that with you very briefly here. But I'm already digging into a lot of my time, so let's go here. So high level, my investment approach again is very similar to what Cole just went over. I've always kind of done it this way, but the way that I see the investable universe, and no matter what fund that I'm managing, it's always, there's a certain amount of companies, but first we want to take out the companies that we already know are not doing what we want to see companies doing. There's companies that might be harming society in some way, and so we take those out. But then we move into fundamental analysis, where we're looking at companies and trying to get a better idea for really what they're doing, what they're about, and seeing if they make good investments overall. And that kind of gets into the overall assessment of whether or not we want to really invest in them, that we want to put them in the portfolio, and really hold them up as companies that are really what we consider to be flourishing, helping society flourish. But once we have a few of those companies and we have a portfolio, we move into the portfolio construction phase, which consists of portfolio optimization and risk management. And really all the portfolios that I manage are high conviction, usually concentrated portfolios, but portfolios we believe are impacting the world in a positive way. So I want to talk about a little bit about my philosophy overall, something that's a little bit unique, something you might not be familiar with, but I want to kind of tee it up in this way. Over time, everybody that's ever put together a portfolio has always wanted to have a quote unquote diversified portfolio. There's a lot of different ways in which you can think about that. But really, we've gotten to a place today where I think when people talk about an equity portfolio, they'll ask you, okay, what sectors are you exposed to? What sectors are you over or under allocated to? And I think that is fine, but I think there's a lot of problems with that. And this became clear many, many years ago to me. And I set out to kind of do it a little bit differently and really get to the heart of what investing and investors really should be looking at. And really, the way that I see it in terms of sectors, there's really three main problems with kind of looking at a portfolio just in through the lens of sectors. The first problem being that sectors more and more are becoming just more arbitrary. There's a lot of these companies out there that are classification specialists, and they'll put these companies into a category or a sector, and a lot of times they can't even agree with each other about where a company should be. And again, it's missing the point overall, but which I'll get into in a second. But the second problem really is that companies have really become a lot more complex. So just because a company might be a technology company or in that sector doesn't mean that they are actually doing something that you would consider technologically heavy. And I'll get to an example of that in a second as well. But there's lots of examples of this, and the point is that it's just really hard to say, okay, so this is a tech company, so now I know what that company does. But even if you did, it doesn't really help you as an investor. So, but the third problem really is that there's just really little useful information that is identified or brought forth by knowing what sector a company is in. It's not that useful to me as a professional investor. So a few examples of what I'm talking about, though. Amazon, GICS, who is the kind of the main classification specialist that most people will refer to when they talk about sectors, puts Amazon in consumer discretionary. And sure, we think about Amazon, what are we going to buy off Amazon today? So it really is a consumer discretionary. But did you also know that it's actually one of the biggest cloud providers? Most of the S&P 500 companies use Amazon in their cloud service. It's a huge part of their profits, maybe not their revenues, but their profits. But they also have food and drug parts of the business, Whole Foods. That's more of a staple, consumer staple. And Prime Video, that could be technology, it could be entertainment, however you want to see that. The point of there is that just by having a label called consumer discretionary does not represent what that company really is all about. And we can go through all three of these. MasterCard, GICS says it's a tech company, information technology company. You might not have realized that, but that's where it sits. Even though the revenue is directly linked to or related to credit expansion and consumer spending. So really what they do is highly complex, and it is a tech company in my mind. People don't really think about it as a tech company, and you really wouldn't put that in the same category as like a Microsoft or something like that. It's very different. So Berkshire Hathaway, GICS says it in financial, even though 25% of the revenue comes from financial companies. The rest of it, 75%, comes from companies that are in very different businesses. And then company we all love to hate, Walt Disney Company. GICS came out with this kind of a random sector a couple years ago, a new sector called communication services, and it's kind of like the place they just put all these companies. They just don't know where else to put them. Basically, is what they're saying. They kind of are saying we're giving up, and we need a catch-all place to put these companies. So that's where Walt Disney sits, and you can think of Walt Disney as a lot of different things now. But communication services, I'm not quite sure I'd put it. I think about it in that context. Instead, what I would submit to you is I think there's a better way to look at the investment universe. What I know is that companies do go through a natural corporate life cycle. Companies start out in one way. If they make it, they tend to grow very quickly. They tend to then decelerate as new competition comes in, or the market that they're in starts to age a little bit, and they might start to going downhill from there into what we call aging, where companies are just growing quite nicely, maybe kicking off some great cash flow, just not producing the returns that they might have once had. And then those companies might, if they're not careful, might fall into what we call the value destroyers category. And those are companies that are not able to use their own capital to produce a shareholder return that is greater than their cost of capital. So they're actually literally value destroying. So this I know is true. And now this isn't, companies don't go through an even life cycle process. Some companies might spend a lot more time in the high growth area, or they might spend a lot more time in the aging part of the life cycle, but they do naturally go through a life cycle stage. And to me, knowing where a company is on this life cycle spectrum is critically important. It's so much more useful as an investor if I have this information, because I know then if a company is in the high growth stage, for example, I know what questions to ask that management team. You've got some great advantages now, you're producing great returns. How are you going to stay in that stage? How are you going to keep those advantages? How are you going to maintain the types of returns that you are now producing? How long is it until somebody else comes in and competes with you? It's questions like that. Or if I'm looking at an aging company, those are very different questions. You've got great cash flow. What do you want to do with it? Is this just going to be the way it is going forward, or are you going to try to reinvent yourself, take that cash flow and buy something else, or should we just expect a big dividend going forward? Those are kind of the questions that are true for every company all around the world. These questions can be asked, and I would submit to you again that there's only 5 companies in the world, 5 types of companies in the world, and this is really how an investor should be looking at a company. This kind of takes the product, the service, the widget, if you will, out of the equation and says, that's a secondary concern. What's more important to me is how good the management is, how good the business plan is, and can they execute on that business plan? And that's really at the heart of what drives shareholder value. It's not the widget, it's how the business plan is executed, and understanding what that looks like on the investment corporate life cycle. So really, there's 3 steps to the process again. The first part is we go through the entire universe and we quantitatively assess each company and put each company into one of these 5 stages on the corporate life cycle. And this is really based on the company's return on investment. So using the company's capital, what is their returns on that capital been over recent history? And then also their asset growth. How much are they growing compared to the rest of the universe? And that really helps us put everything into one of these 5 buckets. The other part of that quantitative process is that we have a screen that we use. It's a multi-factor screen with factors that are different for each stage in the life cycle. We know that each stage is unique. We know there's different factors that are affected at each stage, and we apply a quantitative screen to every company depending on what stage they're in. So this gets us an expected return for every company in the universe, and we focus in on the top 20% of that screen, basically, to go after ideas. Those are the top 20 names that we feel are the most capable of outperforming going forward. So really the bulk of our time is spent in step number 2. It's the fundamental analysis stage. We do a lot of valuation analysis. We have an internal proprietary DCF that we use. We spend a lot of time understanding the valuation drivers of every business. We do a lot of management interviews to, again, understand the business plan, understand what we think their capabilities in executing that business plan might be. But this is where we spend most of our time. I'd say 95% of our time is right in step number 2 here. And then step 3 is again, the portfolio optimization and risk management phase. This is ongoing. This is looking at the risks in the portfolio. Every actively managed fund has risks. The question is, which risks are you comfortable with, and how is it going to change over time, given what we're seeing around the world, economically, business cycle wise, et cetera. So this is something that I do as a PM every day. That's kind of the philosophy. It's a little different. So if anybody has any questions about this, that was a very quick way to go through that, but we'd be glad to talk about that a little bit further if anybody would like. The other question I've been getting a lot with just given how the markets have been going is, why should I be investing in international markets at all? I mean, the U.S. has been killing international markets over the last 10 years plus now. Why do we even bother? And it's a good question, and I've been trying to answer that for the last couple of years. 2 years ago, really, I did a webinar on this, actually, and the 4 points or 4 myths that I presented there really are true today, and I just want to go through those really quick. But I think that it doesn't prove anything, but it actually, I think it'll get everybody thinking a little bit differently. But the first one is the obvious one. U.S. stocks always outperform international stocks. Myth number 1. It's not true. International stocks have actually outperformed 3 of the last 5 decades, if you look back in history. So I know at the end of a cycle like this, and by the way, these cycles tend to last about 10 years or so. This one's been extended a little bit because of COVID and the fiscal and monetary help that we've gotten here in the U.S. But typically these cycles are about 10 years. But also what's happened over the last 10 years is a very strong U.S. dollar. That's been a trend, and that's really helped push more assets into U.S. stocks and bonds, but U.S. stocks so primarily. It is not true. International stocks have outperformed before, and have done so in the last 3 of the last 5 decades. The second myth is that the best businesses and CEOs in the world are in the U.S. I think, sitting here in the U.S., we always hear about these great companies, very innovative companies. We naturally think, well, they must have the best managements in the world. There's just some great homegrown talent here. True, there is, but it's not true that they only are here in the U.S. There's a lot of great companies, and I've had the privilege of knowing a lot of great CEOs over the years outside the U.S. And I'm excited to kind of bring that to you, even introduce you to a lot of those companies, because there's a lot of great things happening outside of our borders here. But just to show this and highlight this, Harvard Business Review does this study once, I think it's every 2 years. And this is back from 2019, so pre-COVID. But in their study, they basically look at CEOs all around the world, and they say, okay, of the CEO's tenure, what has been the stock return over their tenure? And there's some constraints. They have to be there a certain amount of years. But basically, the results were that 37 of the top 100 CEOs were in the U.S. So that means that 70%, a little over, of the top CEOs or CEOs that are producing the most shareholder value are outside the US. And that says a lot, given how good the US market has done, right? So, if you look at the top 20, only 9 are US based. So more than half are outside the US. And by the way, most of those CEOs, those 9 CEOs, are in the tech industry. So when you think about how tech is done, just from a stock point of view, it's not surprising. But you know, the correlation between tech prices and CEO talents, might not be that strong. So anyway, myth number 3, I get this a lot. So the European economy is lagging, and it could be any economy. Take South American economy, any economy. But the question is, the European economy is lagging, so there's really no need to invest there, right? Well, that's kind of a belief, I think, that's universal, but it's missing a little bit of the point. And to highlight this point I'm going to try to make about this is that when we looked at the top 100 European companies by market cap, and we looked at where their sales exposure is, only 39% of their total sales exposure is to the European economies. So really over 60% of their sales exposure is outside of Europe. So it's not exposed to whatever is going on in Europe. So the point there is that there's some great companies that are doing good things, but aren't necessarily beholden to whatever the economy or economies do there in Europe. So they could be selling things here, they could be selling things in Asia. There might just be some good companies domiciled in Europe that are selling everywhere else in the world. So just because it's located in an economy that might not be that good doesn't mean that we should not invest in that economy at all. And by the way, only 35 of those top 100 companies cross the 50% mark. It's an interesting stat there. The last one is that the U.S. market has been the strongest because it's been the healthiest. I think that's kind of something that we're just kind of born and bred to understand and realize that we are the best. The economy here is just great and it's been healthy. But I think that we forget that we've had a lot of help. Interest rates have been artificially low for the last over 10 years now. We've been in a period of quantitative easing since 2010. That's been the reason and the driver of those low interest rates. But that's been extremely helpful to U.S. assets, whether you're talking about your house or bonds or stocks. So that has really helped over the last 10 years, and it has been a huge driver in everything that we've seen. But I would ask, do you think that's going to last? Because it's obviously already reversed, and I don't know if it's going to reverse again to the extent that I think equity holders wanted to here in the U.S. So in other words, this period of QE and artificially low interest rates may be over. So something to consider. One other thing too, the corporate tax cuts that we had in 2017, those really helped to extend this cycle in a big way. People don't really realize this. There was a lot more after-tax profits, but I think what the tax cuts were hoping, I think Trump was hoping, and I think economists were hoping a lot of that would be kind of driven back into, those profits would be driven back into the economy, into capital spending, R&D, those types of things. The truth is most of that went into buybacks, a huge amount, almost all of it, in fact. So that was a huge tailwind for stock prices, and I'll get to that number in a minute. But when again, just to kind of highlight the disconnect here, corporate profits actually fell 17% from 2014 to 2019. This is pre-tax corporate profits. Most people don't know that either. Now, it looked good from an after-tax earnings perspective, but corporate profits pre-tax actually fell in that period. So something to just be aware of. Another point, between 2009 and 2018, the S&P 500 companies spent 4.3 trillion on buybacks, or 52% of net income. 4.3 trillion on buybacks. That number is staggering, and obviously a huge part of the overall capital flow over those years in the U.S. And by the way, 30% of those buybacks in recent years have been made with debt. So companies adding leverage to make those buybacks. And by the way, total corporate debt has doubled since 2011. So we're looking at more levered companies, hugely susceptible to rollover risk. And so what I mean by that is, when that debt expires, you pay it off and then you try to issue more debt if you can, but you're going to do so at a much higher cost. So that's something that companies, countries are now coming to realize, and it's going to be a huge risk over the next few years. So all of this is just kind of pointing out, you know what, this has helped a lot in the past here in the U.S., but this time might be over. You know, the corporate profits or taxes rather are going to go up. We know that. So that tailwind might stop and reverse actually. Buybacks are now talked about as being taxed. You know, Congress is going to make it a little bit more difficult, and there just will be a lot less cash to go around for buybacks, I think. So that tailwind again, it might not be there. So all this to say that, you know, we should be looking to diversify. We should be looking elsewhere. And when I look at international markets, there's some great companies out there. They're so much cheaper than they are here in the U.S. And they are overlooked. So that is definitely the reason that we should be diversifying away from the U.S. Into other markets. So I just wanted to go through a couple of examples real quick of companies that I've invested in over the years. Some great companies I've had the opportunity to get to know well. But one is a bank in Indonesia, Bank Rakyat, and some of you have heard me talk about this last week actually at our conference, which I really loved spending time and meeting a lot of you there. But just to go through this again real quick, in Indonesia, they have a government-sponsored microloan program. Some of you might be familiar with microlending in general. It's sometimes a difficult subject. It's very nuanced, and there's different ways to do it. But Indonesia has really figured this out, I think. And what they do is they have a government-run program, but they partner with banks to really administer and do the lending for this program. And it is a fantastic program, and I think they've just nailed this idea of micro lending. You know, what they do is essentially they cap the interest that you're allowed to charge lenders, which kind of takes care of that problem that you see in a lot of different countries of predatory lending and lenders really trying to take advantage of the borrowers. So that problem is solved with this program. The other problem is that you know, given that you've got that cap, and ultimately the bank might want to go out there and lend to whoever they can. There might be a problem with loan losses, and that might be a big risk for the banking sector in general. But it turns out that first of all, the government will cap these losses for the banks. That is one of the guarantees. But it turns out that if you do this the right way, the borrowers pay back. And you know, Bank Rakyat's loan loss ratio is about 3%, or has been lower too in years. That's amazing for an emerging market bank that is lending to very small lenders, or lending to very small borrowers. So anyway, the bank has been a phenomenal success. It's averaged an ROE of over 21% over the last 10 years. But more importantly, really, when you look at the poverty rate, so this program has been going on for over a decade now, but when you look at the poverty rate in Indonesia, it's gone from 82% in 2009 down to 50% as of last year, according to the World Bank. that's a huge staggering number that so much poverty has been alleviated from that country because of this. It's not the only reason, but it's a big reason. This bank has got 31 micro and ultra micro borrowers. So they touched a lot of lives and really found a long way to solve that problem. Another company is Ambu in Denmark. There's a problem with reusable scopes. Scopes, when you think about when you go in for some kind of ENT scope or a colonoscopy, something like that, those scopes that are being used are primarily reusable scopes. You go in for procedure, they're clean. After you're done, they're cleaned and they're used again tomorrow. There's a lot of infection risk. Ambu has kind of solved this problem with creating this single-use scope, and it's been a huge success. Now we're out of this investment now, but when we had it, it was a huge success for us. We made over 400% in that stock. So another company that we've owned over the years was more of a what we call a value destroyer. This is a company, it's a turnaround story, and it's kind of a boring auto parts maker, but they've completely redone what they do, refocused the company and totally restructured the company, and it really had to do with a management change they made in 2009. But a very inefficient company went from a very efficient company and changed their focus from really having no focus to focusing everything they do on lowering the CO2 output in automobiles, and how do we help them do that. And then now they're refocused again on cars producing no CO2, so the electrification of cars. So this kind of story in moving from producing just product to helping society, helping what they do for a living, helping cars become more efficient, has been a great story. But this value destroyer, which once was a value destroyer, has produced an investment return for us over 600%. So I'm running out of time and I can't really go into it more, but if anybody has any questions about any of these companies, there's a lot more of them out there. I'd be glad to talk to you about any of these. But I think that's it for me. One other thing, as far as the new strategies go, they're not new. I've been running the emerging market strategy now for over 2 years now, but the international strategy has been going on for 13 years. But this track record starts with my days at Shelton, and it's over 6 years now, I believe. So the top one is the emerging market strategy. That the top number is ours in blue there. The bottom number is the index number. So quite a good differential there. And then the international is below that. And the index is right there as well. So again, any other questions anybody has, be glad to talk about any of this offline as well. So thank you for your time. And Cole, I think I'm going to hand it back to you, or Nathan, I believe. Oh, there's going to be a Q&A. Sorry.
Well, thank you, Andy. Lots of great information. And like I said, so glad to have you on our team. We want to keep, in the interest of time for the live call, we're gonna move on. But again, if you have questions, we'd love to get back to those today and throughout the week. So please send those to info@oneascent.com. We've already had a few come in, but we want to respect everyone's time this morning. And so we're going to transition as we move to the last portion of our call to Nathan Willis. And so, Andy, if you'll switch off your screen, and we'll go to Nathan. As I said at the top of our call, we have to do two things really well. One is allocate appropriately and select great managers like Andy. And so Nathan is our director of portfolio strategy, and he leads both our asset allocation committee and our manager selection committee. And so Nate, welcome to the call, and look forward to hearing from you.
Thanks, Cole. I appreciate it. And thanks, Andy, for your good words. It's great having you here at OneAscent. So for the fourth quarter, we are going to do a review first of the third quarter. Unfortunately, that's not going to be fun. You're not going to enjoy it because it hasn't been a fantastic year. And you may tend to react emotionally to what we're going to see. So what we need to do is anchor ourselves in the data, and that's what our navigator process does. So we're going to go through that, tell us what the data says about what our outlook ought to be. And then we're going to talk about what actions you should be taking in your portfolio. So first of all, let's dig in. Cole showed these returns, and we're not going to spend more time on this, but we're going to expand it a little bit. And we're going to hide some of these other assets and focus on mid-cap stocks so that we can talk about the differences between growth and value and what that might tell us about what the market's worried about and what might happen going forward. So as you can see, in the third quarter, growth stocks really outperformed value stocks. And they did that, unfortunately, by losing less. They only lost about 0.5%, whereas value stocks lost almost 5%. And the reason for that reflects the changing concerns in the marketplace. Companies that can grow earnings really well often perform better leading into a recession because their pricing power is going to help them out. This is a reversal of the last year, where you can see mid-cap growth stocks are down 30%. Mid-cap value stocks are only down half that much. And so we've seen the market worries shift. So mid-cap growth stocks sold off tremendously in the first half of the year, mainly due to valuation compression from interest rates. And now the shift is, are those high interest rates going to lead us into recession? So let's take a look at that. This chart shows Federal Reserve rate hikes, because that is the answer to the question, what drove the market this year? So the top half of this chart shows the S&P 500 in blue and the Bloomberg aggregate bond in green, and they both lost a bunch of money this year. You can see in the third quarter, the S&P 500 kind of recovered a good bit from mid-June into mid-August, but then has retested its lows, which I actually think of as healthy, but we'll go into that later. But on the bottom, what we see is the Fed funds rate, okay? And you see it steps up 5 times. Those are the times that the Fed hiked rates. What the Fed does on a quarterly basis, they give us something called their summary of economic projections. And so when they met in December, they told us that they thought Fed funds rate this year would be 0.9%. Okay, well, we already surpassed that the first half of the year. Now, I apologize. I'm talking about the Fed and what a bunch of old economists are talking about. So we're going to try to put a little more drama into this. But the problem is actually what they thought about next year. So going into this year, they thought the rate would be 1.6%. And we blew through that the first half of the year. We're already at 3.25%. And in a couple of weeks, the Fed's going to meet again and raise rates probably to 4%. And then maybe again in December. So the Fed funds rate may be 4.5% by the end of the year, when they expected it to only be 1.5%. So 3% above where they thought it would be only 10 months ago. And that surprise, okay, is what has hurt the market so much. The worry in market participants is the Fed is what's called behind the curve, or behind the curve of decision making, of raising rates too slowly. And what that means is they may have to raise rates too much because the cat got out of the bag, so to speak, in terms of inflation. So this has obviously caused a lot of volatility in the marketplace, not just losses, but things have gone up and down a ton. A couple of days ago, we had a CPI number, which was too high, and the market sold off 2% the first hour or so. All of a sudden reversed up 5%, okay, and then finished the end of the day down up 2% after being down 2%. So we've seen a lot of volatility. So let's look at volatility in the long term and see what that tells us. This is a chart that shows the stock market and volatility. So the top is the S&P 500, and this starts January 1 of 2000, okay? And the bottom shows in blue the stock market volatility measured by the VIX, which a lot of people know about. A lot of people in the press talk about that. But we're also showing bond volatility, which is called the MOVE index, okay? It's similar to the VIX, but it's for bonds. It measures the volatility of bond futures contracts, okay? And so the reason I'm showing this is because it's relevant to what's going on in 2022. So normally you see this pattern that when stock market volatility goes up, bonds are pretty volatile too. Well, in the pandemic, that didn't quite happen. You see stock volatility spiked a tremendous amount, but bond volatility really only spiked a little bit. And the reason for this was what we call a loose Fed, or a Fed creating very loose financial conditions during the pandemic. So what they did is they dropped rates down to 0%, and they started buying assets, right? And so that put money into the financial market, which helped the economy to recover. So that's what we call a loose Fed. Well, the opposite thing has happened in 2022. We have a tight Fed where they're raising rates and they're undoing quantitative easing. In fact, they're doing the opposite. They're doing quantitative tightening where they're pulling money out of the system, which is slowing things. What that's caused is bond market volatility to spike. And even though there have been losses in stocks, the volatility has not been that much, okay? So I told you it would not be a ton of fun looking at the third quarter and the last year because we've had a ton of volatility and a ton of losses, okay? But with all this volatility and all these losses, a lot of people have a tendency to react emotionally. So how do we really need to think about the market going forward? And our answer to that is data. But first, what we need to mention is this has been the most restrictive Federal Reserve since the 80s, okay, in terms of how fast they've raised rates and how high they've raised rates. That caused bonds to sell off, which has caused stocks to sell off. So what do we do after this sell-off? We've got to anchor in the data. That's our navigator process. So we look at valuation, the economy, technicals, and sentiment indicators. So we're going to go through this and tell us what the data says about how we need to think about the market. So first of all, we're going to look at stock valuations in a historical context. This is from JP Morgan. They do a great chart every month in their guide to the markets. And this is a 25-year chart of the PE ratio of stocks. So today's prices versus the estimate of next year's earnings. And you can see that ratio has gotten a lot cheaper, right? We're at 15 times earnings at the end of the quarter. And this is down drastically from the beginning of the year. So let's put it into historical context and see if we're overvalued or undervalued. You can see on the right column here where it says standard deviation overvalued or undervalued. That's just how much expensive or how cheap it is. And so what I'm going to draw your attention to is the PE ratio, that first line there, which is the forward PE ratio. Two things about this that are important. Number one, it is the one that is the most undervalued, okay? It's a half a standard deviation undervalued. Number two, it's the one that relies on next year's earnings, okay? So it's very, very important that earnings are good next year. Now, we've known that earnings would decelerate from the strong recovery in 2021. And so the question is, what's going to happen to earnings? That's very important. So we see bonds being, we see stocks being cheap, but not incredibly cheap unless the earnings come through. In the same way, bonds are good, but they're a caveat. There is a caveat to bonds. So they've gotten a lot cheaper. And what that means is as we've lost money in bonds, which is very rare, but we've lost a lot of money in bonds this year because interest rates have gone up. So last Friday on the 14th of October, the blue line shows you the 10-year yield over the last 10 years. And you can see it's at 4% last Friday, and that's the highest it's been in 10 years. The red line, the next one up, is the lowest rating of investment grade corporate bonds, so triple B bonds. And they're at 6.25%, so really good yield. And then high yield bonds, the junkiest of bonds, are at 9.5%. That's the only one that's not above where it's been for the last 10 years. High yield bonds blew out wider in the pandemic and blew out wider during 2016. And to me, it's interesting that high yield bonds haven't done worse. It feels to me like the high yield market doesn't necessarily expect a recession or as deep a recession as maybe some other people are talking about. So valuation, we call neutral. When we're looking at the economy, we need to talk about inflation first. So last quarter, we told our little story about coffee and the inflationary pressures that were in your cup of coffee and how they're kind of reducing. All right, so let's go through those again and give an update. So the first source of inflation is easy money. The Fed was dumping money into the system. The current status is that they're raising rates and reducing the balance sheet. So that source of inflation is mitigated. The second is the pandemic fiscal stimulus, and that's finished. Finally, supply chains are improving. Unfortunately, the war in Ukraine is red because there's really no end in sight there. So that's still definitely an inflationary pressure, particularly in the energy markets. But going along with that, we've been talking for some time about some deflationary forces. And so let's go through those. First of all, we have three deflationary forces that are short-term and line up with these sources of inflation that we've seen over the last year or two, right? So the end of quantitative easing, the end of the fiscal stimulus, and supply chains are improving. But then there's two more that are much more long-term, but that are pretty powerful forces. We've talked about these a little bit, but I'm going to highlight them again. The first one is demographics. There's been a decline today over the last 15, 20 years in working age population, i.e. people who spend a lot. as opposed to the post-World War II population boom in the 1960s and 70s, where a ton of people entered the workforce and started spending money. That was very inflationary, where demographics today are very deflationary. And that applies globally, not just in the US. Secondary, we had a huge technology boom that started in the 80s. So it didn't exist in the 60s and 70s, the last time we had really bad inflation. And that's a really significant deflationary force. So let's talk about commodity inflation pressures, though. We showed this chart again last quarter. And what we said here was commodities have really spiked, mainly during the first quarter of 2022. And some have gone up and some have gone down in the second quarter, but we felt like things were beginning to lessen. The pressures of commodity prices were declining a little bit. And so let's look at the third quarter. So if we extend this, it looks like that story is continuing. So inflation is becoming less of a problem. Now, this is just commodities. And the problem in the last couple of months of inflationary data has been the services sector, right? So transportation, let's say, is up because gasoline was up in the prior quarters. Well, these things are all going to flow through. And so it makes sense to expect inflation to continue to moderate over time. So the next thing we need to think about is our economic indicators. And what I did is I just pulled a few here. This data is presented the same way as commodities data, in that the more green it is, the better, right? That could be going up or going down depending on the data source. And if it's more red, that means it's worse, okay? So if we look at kind of four big areas of economic indicators, it looks like growth is doing fine. The very first line, the manufacturing PMI, the Purchasing Managers Index, is above 50. And above 50 is expanding, is getting bigger. So that's a positive, although it's slowed a little bit. And then when we go to employment is good. The employment market is really strong and consumers are really strong. The bad stuff is really inflation and what the Fed is going to do about it, right? So when you look at the data this way, a lot of the data is really good. And a lot of what is bad or what is worrisome is what will probably happen in the future. So I think it's worth keeping anchored in that, and that'll reflect itself in how we prepare for the future in the portfolios. So what we need to think about, though, is what happens to our portfolios if we do have a recession. And so we're going to talk about that on this chart. There's a lot to this chart, but I'm going to use our first data point to illustrate it. The red dots are bear markets where we've also had a recession, okay? The green dots are bear markets where we've not had a recession. And the blue dots where we are today, because we haven't been defined as having a recession yet. Okay, so let's look at our first data point and see how to look at this. So in the 1929 to 1932 stock market crash, that occurred during the Great Depression. And so GDP declined by 45%. So negative 45%, very far to the left. And the stock market lost almost 90%. So you can see from top to bottom, it went down 90%. So further to the left is a worse economic decline, and further down is a worse stock market decline. So let's go through these chronologically to just think about what it tells us about the future. So we obviously had another bad stock market during the Great Depression, during the end of it. Then we had another pandemic. This was the Asian flu pandemic in 1956 and 57. Then we had another inflationary scare in 1968 to 70. Then we had the oil embargo, as I call it, energy crisis number 1. Then we had energy crisis number 2 after the Iranian Revolution. Then we had the 2000 tech bubble, followed by the global financial crisis and the pandemic. When you kind of take a step back and look at this, the takeaway for me is that unless we're going to have, or we're on the cusp of, a really significant crisis, there's a pretty good chance we're pretty close to the bottom, right? There's not much more downside. This is not particularly scientific, but I think it's worth kind of anchoring in history and saying, look, it may not actually be as bad as we think, right? A lot of risk is stuff that doesn't happen. And that's maybe where we are today. So when we kind of bring this all back to our navigator, the economy is neutral. So then let's look at the technicals. And this is a chart of the S&P 500 on the top over the last 5 years. And then on the bottom is what's called the relative strength index. And this is a technical indicator that tells us if the market is oversold or overbought. So when this line, this index, gets above the red line, which is 70, the technicians say the market is oversold and there's a pretty good chance that it might sell off. Okay. When this number gets below 30, they say the market is oversold and the market might, have a really good rebound. Well, I put the vertical lines on here to show each quarter end, and that rightmost line is September 30. The last week of September, we got a really good oversold indicator. And since then, the market's really, bounced pretty good. So the short-term technicals are actually really positive for the market right now. This oversold condition creates a potential for a really strong rally. The next thing we're going to do is we're going to look at long-term trends, and we're going to go the longest term trend we look at. Okay. So this is a chart of the S&P 500 and the 200-week moving average. So 1,000 days of 1,000 trading days. And it's really interesting. You can see very clear patterns here. You see the first half of the chart is a really strong bull market that started in the 80s. And then in the middle, this moving average really flattened out. And that was kind of the lost decade of the 2000s. And then we've been in a really strong bull market since then. And another thing to note is the market doesn't trade below this 200-week moving average very often, right? The market goes up over time because earnings grow. But the market kind of deviates from it. You see the market get a little further away from it during the tech bubble and it comes back. But it's a really good thing to anchor. And the 200-week moving average was hit. The market traded right back down to it over the last couple of weeks. And I think just yesterday and today, the market has bounced really strongly, in part because it hit that level and it's kind of bounced off of it. So we don't hang our hat on this a tremendous amount, but the market is in a long-term trend that's up. And at this point, that trend is still holding, and it's actually a really good support for the stock market today. So technicals are actually positive. The last thing we look at is investor sentiment. This is a chart we look at a lot. Investor sentiment is a contrarian indicator, and it's been negative for a while. That red line is the number of investors that are bearish, okay? And you see back in the end of the first quarter, it hit 60, and then it hit 60 again in May, and then it got above 60 in the third quarter. What I want to do is kind of look at the longer term and tell us what we see and what we can glean from that. So this is a chart of the S&P 500 going back all the way to the early 90s, so from 1992 on. And then the bottom chart is this measure, the percent of individual investors who are bearish. And bearish is defined as they think the market's going to go down over the next 6 months. And I put this red line on that bottom piece of the chart. That shows where we are today. This was last week. And you can see it's higher than we've ever been, except for twice during the global financial crisis. Interestingly, the end of 2007, when things were kind of just starting to fall apart, and then the depths of it in October of 2008, I think, was the only times it got as bad as this. But what I wanted to do was look at all the times it spiked over this time period, and then kind of what's happened after that. So let's just go through these. The first one was back in the 1998 Asian debt crisis during the tech run up to the tech bubble. The second time sentiment got bad was actually before the tech bubble burst in March of 2000. Then again, a few times near the end of the tech bubble. Then we had at the beginning and the end of the global financial crisis, another one coming out of the crisis. Then we were stable for a while until 2018, when the Fed was trying to do quantitative tightening like they're doing today, but they stopped. They were able to stop because interest rates were so low, whereas they can't stop now, which is worth noting. Then we had another high reading during the pandemic, and then we're in another one today. So what I wanted to do is not take an incredibly scientific view of this, but just kind of put arrows on this chart to show what happens after you hit these readings. And so if we look here, the market goes up much more than it goes down. In fact, there are 8 kind of times, and 6 of these, the market went up after these kind of readings, and 2 of them went down. So when market sentiment, investor sentiment is this bad, there's a really good chance of making money over the next year. And that's really where we are today. Another sentiment measure we look at is the University of Michigan Consumer Sentiment Index. This chart is a little busy, so let me talk about it for a second. You see all these blue dots, and they are either peaks, and there were 8 of them in this chart, or they're troughs, so bottoming of University of Michigan consumer sentiment. And so then the number next to the peak is what the stock market did for the 12 months following. Okay. So what I'm going to do is point out this one where we are today, we're at 58.8. And then let's go look at the data up in the top left, the 8 sentiment troughs. If you invested, then you'd earn 25% on average over the next 12 months. So again, consumer sentiment, just like investor sentiment, is really negative. So we, lows in consumer sentiment are really good. And so we think sentiment is actually a strong positive at this point. So when we kind of wrap up our navigator, there's actually a lot to be happy about here. The biggest thing to be worried about is what might happen, right? What the Fed might do. And so it's worth considering that all is not lost. And we need to have a reasonable view and a reasonable asset allocation. So that takes us to what we ought to do. First of all, we're going to talk about some things you shouldn't do, right? Some pitfalls to avoid. So I know it's hard to right now, but let's avoid emotion, right? We need to expect volatility to continue. You want to use it to your advantage if you can. And also one thing that we've been talking about recently is, consider alternatives, talk to your advisor if you really feel like you need to limit the volatility. We don't want you to get out of the market, but maybe there's another set of tools you can add to your portfolio. So what I want to do now is talk about keeping the news in perspective and not reacting emotionally. So this is a stock market chart for the 10 years ended 1989. So it starts in the third quarter of 1979, right when this headline came out, or this front cover of a magazine. So this is a real famous Business Week magazine that said the death of equities, right? And of course, it started a huge bull market. This came out in August 13 of 1979. And on that day, the S&P 500 was $107, right? 10 years later, it was a Sunday, so Monday, August 14th, the S&P was 343. So you made 2.5 times your money investing just when the press told you not to, and holding for 10 years. So it's really important. Another thing, we've been talking about consumer sentiment. So this is a chart of consumer sentiment during that time. And May of 1980, a couple months after this, is when consumer sentiment was at its lowest reading between then and today. Consumer sentiment, a really good contrarian indicator and something we need to just pay attention to. So ignore the press. That's one good piece of advice that we always give. The second thing we don't want you to do is to panic, right? So we want you to remain invested through the volatility, dollar cost average if you're in a position to, and also take advantage of tax loss harvesting. But what I want to do is, again, update a chart we looked at last quarter. So this is a chart of the S&P 500 in blue, and this starts at a market peak. I went ahead and started this in January of 2000. If you were invested in the S&P from January 2000 until September 30, you earned 4.5%, right? 4.33%. Not a really good return, but you're investing at a peak, and we're in a big drawdown right now. However, if you said, I'm going to get out, and you missed the 10 best months, you would have only earned 3% cumulative over the last 22 and a half years, right? You would have earned less than 0.25% a year. More importantly than that is, what do these months tell us? This list of months is over there to the right. The strongest months often occur before the crisis is over. So look at some of these on here. The second one is April 2020, the height of the pandemic. The stock market was up 12.7%, right? The very bottom one, October of 2002, was the last bear market month of the tech bubble crashing and bursting. Everything was really bad. And then you saw March and April of 2009 really in the throes of the financial crisis. So before the crisis is over, you have really, really good months. And also, oftentimes, these strong months occur near the end of a bear market during periods of capitulation. So it's really important to maintain your discipline. And we're doing that. And so let's talk about what we're doing for you in your portfolios and what we would recommend that you do. So we recommend that you maintain discipline. And so a couple of things we've done, we've made a small shift from international to US value. And I completely agree with Andy. There's a lot of really good opportunity in the international markets long-term. This is more about kind of the short-term economic situation, kind of differentials between the two regions. We've also improved our execution of our international strategy by shifting to local shares instead of using ADRs. which is important. We've done a lot of work on that, and we can share that with you if you like. And then in terms of discipline, our stock weighting is today slightly above our long-term allocation target. So we're not running for the hills. It's important to know that we still feel slightly positive about taking risk in this market. The second thing we're doing, what we always do, is we're evaluating portfolios, right? So we've evaluated the quality and the maturity of your bond portfolio holdings. In fact, we've extended the maturity a little bit of your bond holdings, so we're kind of neutral relative to the benchmark. So in case we start to go towards a recession and bond market yields drop, we should make money from that. And then I think you've probably grasped from what I've talked about today, we're watching the economy and technical factors closely, and we're really paying close attention to the third quarter earnings results, because that's really going to drive what we think is going forward. Thanks a lot for your time today. I enjoyed it and would love to answer questions, probably not today, but at some point in the future. Cole?
Thank you, Nate. If you'll advance to the last slide as we wrap up, we got to go really deep with Andy and hearing about specific companies and how he looks at very specific markets, and then also go really wide. Nate, thank you for sharing all of that great information. We did have some questions come in, and in the interest of time, we'll answer those offline, but please send those to us, info@oneascent.com if you have them. If you'd like to learn more about our values-based screening approach, about how we think about investing, how we serve advisors or clients, you can do that on investments.oneascent.com. Lots of information there. Here are just a few examples. All of the normal social media channels, and we love to talk to you by phone as well. Our number there is in the bottom, 205-847-1343. Thank you so much again for investing a portion of your morning with us. We don't take that lightly, and we appreciate you spending some time, and look forward to speaking with you in January on our next market update. Thanks so much, and you may now sign off. Bye-bye.